joining us now are two analysts who cover First Solar. Aaron Chu is a senior analyst at Maxim Group, and he's going to sell in the stock. His $85 a share target is the second lowest among analysts surveyed. And we've also got Jeff Bencik. He's a senior equity analyst at Kaufman Bros. He has a buy on First Solar. And why don't we start with, the good news here. Jeff, you say you have a $150 price target?
Exactly, $152 price target. And that's really based on 16 times our estimate of 948. With the company growing more than twice the S&P, we don't think that is really a aggressive price target based on that multiple. At the end of the day, First Solar is the lowest cost manufacturer of solar modules and the lowest cost builder of solar power plants. So with that, we believe that it's going to has a long-term sustainable competitive advantage over much of its competitors. So it will be the long-term winner. The stock has been hit because of macro concerns on the overall solar space, but as you can see, First Solar is the only company really in the solar space that did reiterate its full-year guidance. All right, so Aaron, obviously you don't think they've been unduly penalized for what's happening on a macro level. Why do you think the stock is only, though, worth $85? You think there's more going on there than just macroeconomics?
Yeah, not only do I think it's only worth $85 of note, the price target was set a couple months ago. There's probably a decent downside to that at this level. The stock's trading around 90 now, just given the deterioration in pricing in the market. My take is twofold, really. One is First Solar is exposed to the solar industry, and frankly, for better or for worse, as exciting as the unit growth story is going to be over the next couple of years, simple truth is solar is dependent upon subsidies, which are coming down, and secondly, suffering from severe price compression throughout the entire value chain and throughout the entire industry. So. The downside is the unit growth story is strong, but the simple fact is if you add up, if you just do the simple math, I'm talking to some people in Europe right now that are reportedly noting First Solar pricing already down to around the $1 per watt level. They can produce around 76 cents a watt. You're talking about a 25% gross margin. Let's say they do 2.4 gigawatts, which is roughly their capacity next year. At back out a 15% OPEX to sales ratio, and you get to an operating income level around 200 million, and you divide by your 88 million shares outstanding, and you get to like a $2 EPS level. What's missed about the story, real quick, is that 2012 and 2013, they're probably going to actually report very strong earnings. So if you look at it on the surface, it looks like they have very strong earnings growth, and what's really missed most often about the stock is that the earnings power in 2012 and 2013 are largely a mirage. It's really driven by 4 very high-priced contracts that, in my view, are totally unrepeatable and really one-time in nature. So this company may be able to do a $10 EPS number, but $8 of that earnings is going to be driven by pricing and contracts that, in my view, are not repeatable again. Your normalized earnings power probably, at this point, below $5 just in their core business.
Jeff, I want to bring you in. You talked about First Solar being a low-cost provider. In an industry where we know solar prices are falling, polysilicon prices are falling, why is that an advantage anymore? Everyone's low-cost all of a sudden.
Well, they're really not. Even after the price of polysilicon has dropped from $500 to $50, what has happened there is the price of a module has dropped from $4 to, let's say, $1.25 to $1.35 for the low-cost Chinese manufacturers. The best low-cost Chinese manufacturer is probably Trina Solar with a cost of around $1.15 per watt. And First Solar's cost is 75 cents per watt. So they still have a 30% plus cost advantage over the next closest manufacturer.
And what do you say to Aaron's argument that First Solar's earnings are basically manufactured for the next 2 years, and after that it's going to drop?
Well, it's not that they're manufactured. They signed attractive contracts over the last couple years at fixed pricing with utilities that is going to give them a very strong earnings. I agree with them on that.
Do you agree, though, that they're not repeatable?
Well, the repeatability of it is based on the current contracts, and currently First Solar and others are signing PPA agreements, power purchase agreements, for less than 10 cents per kilowatt hour. So that's certainly lower. 2 years ago, they were signing for 16 cents per kilowatt hour. A year ago, 12 to 13 cents. So there is another 20% decline built into that. If you look at what First Solar has done historically, they've averaged 15% cost reduction per year since 2004, since their IPO. So I think most of that, even though the pricing won't be as attractive, their cost reduction has been proven, and they will likely be able to do it again.
All right, we got to leave it there. Thank you both for joining us. And Sheila, thank you for your series this week. Interesting look at First Solar. Two very divergent views, clearly. Aaron Chu of Maxim Group and Bencik of Kaufman Bros joining us for today's Hit or Miss series on First Solar.